All right, welcome to The Explainer. Today, we're going to pull back the curtain on one of the most important rules in all of business finance. Seriously, it's a standard that totally changed the game for how companies report their sales, and it tells a hidden story that's behind every single transaction.
So let's kick things off with a little puzzle. It's one that honestly baffled investors for years. You know that free phone you get when you sign up for a new 2-year plan? Yeah, it feels free, right? I mean, they tell you it's free. But in the weird and wonderful world of accounting, that free phone is actually a massive revenue event. So, how on earth is that possible?
Well, here's the deal. The way it used to be, under the old, kinda messy rules, that phone generated exactly $0 in upfront revenue. Why? Because you didn't hand over any cash for it right then and there. But now, under the new global standard, the company gets to book the entire value of that phone on day one. So how did we get from zero to, well, a lot? The answer is this huge shift in how we think about revenue.
Okay, so this huge change all happened because the world of accounting basically decided to clean house. They moved away from this confusing mess of rules that were different for every industry, rules based on vague ideas like risks and rewards. And instead, they landed on one single powerful principle that works for everyone. And that principle? It's all about the transfer of control. This is the key. Revenue isn't about when the company sends you a bill anymore, or even when you pay it. It's all about the exact moment that you, the customer, get control over what you bought, whether that's a product or a service. This one idea, it's the engine that drives this entire new way of thinking. So, you might be wondering, how do accountants actually put this idea of control into practice? I mean, they're not just winging it, right? Nope. They have a super logical 5-step framework. Think of it as their toolkit. Okay, so here's the roadmap. First, you identify the contract. Simple enough. Second, you have to pinpoint all the separate promises in that contract. They call these performance obligations. Third, you figure out the total price. Fourth, and this is a big one, you have to slice up that total price and allocate a piece to each of those promises. And finally, step 5, you recognize the revenue as you deliver on each promise. What this does is it forces a company to be really clear about what they're selling, which gives us a much better view of the whole deal. And you guessed it, these steps are exactly how we're going to solve our free phone mystery.
All right, let's put this framework to the test. We're going back to our telecom example, and you're about to see what's really going on with that so-called free phone.
So let's break it down. Step 1, the contract. That's your 2-year plan. Let's say it's $70 a month, so over 24 months, that's a total price of $1,680. That's step 3. Now for step 2, the important one. What are the promises here? There are 2. Promise number 1 is the physical phone. Promise number 2 is 24 months of cell service. So step 4 tells us we have to take that total price, that $1,680, and split it between the phone and the service, based on what they'd cost if you bought them separately.
And boom, here's the result. It's a total game changer. A huge chunk of that revenue, maybe $800, gets recognized the second you walk out the door with that phone. Why? Because that's the moment control of the phone transferred to you. The rest of the money, what's left for the service, gets recognized bit by bit, month after month. This creates something on the balance sheet called a contract asset, which is really just a fancy way of saying the company has earned money it hasn't billed you for yet. And this is key. It creates a permanent split between when the cash comes in and when the revenue is actually recorded. Now, understanding all of this is absolutely crucial because whenever there's judgment involved, well, there's a risk that someone might try to bend the rules. This new system is powerful, for sure, but it also opens the door for some, let's call it aggressive accounting.
And I'm not talking about a small problem here. Get this, improper revenue recognition is the #1 reason the SEC goes after public companies for accounting issues. It's involved in something like 43% of all those enforcement actions. That's huge.
So what kind of shady stuff should you be on the lookout for? Well, a lot of it boils down to booking revenue way too early. You've got schemes like channel stuffing. That's where a company forces a ton of product onto its distributors right at the end of a quarter just to make their sales numbers look good. Or there's bill and hold, where they literally send you a bill for stuff that's still sitting in their own warehouse.
So as an investor or an analyst, you're not helpless. You can use some real forensic tools to spot these red flags. Things like a sudden jump in how long it takes to collect cash, or a high M-score, which can hint at manipulation. Even something like the CFO quitting can be a warning sign. But here's a really powerful one to watch, the cash conversion ratio. All that is the company's operating cash flow divided by its net income. If that number is consistently hanging out below 0.8, that's a major red flag.
It suggests the company is booking a lot of paper revenue, but the actual cash isn't showing up.
Okay, so let's zoom out. Why does getting a handle on this kind of technical accounting stuff actually make you a smarter investor, a smarter financial thinker? Why does any of this really matter?
Well, here's why. Because it forces you to look past the headline sales number and see what's really happening in the business. You stop just seeing a sale, and you start seeing the specific promises a company's making to its customers. And even more importantly, you see how and when they're actually keeping those promises. And in the end, that's what this is all about. Understanding how revenue works is really about understanding the true story of a business. It gives you the power to ask the most important question there is. Is this company making real cash from the promises it keeps? Or is it just booking paper profits from promises it hasn't even delivered on yet?